All right, it's been a while since I've done a market outlook video. I was noticing it was 6:13 Monday, not this past Monday, but the Monday before. It was quite of a bad start to a bad week, but then this week has been a pretty good week. So there's been a lot that's happened in the last couple of weeks, both to the downside and to the upside. So I'm going to break down the significance of the size of last week's move and the size of this week's up move, and whether or not we have formed, we are in the process of forming a low point, and what does it look like compared to other corrections, specifically other corrections that eventually led to bear markets like this has the potential of doing, considering the type of market and especially economic environment that we're in right now. And from an interest rate environment that we're in right now. So we're going to break all that down. We're going to break down what's fueling a lot of this rally this week. We're going to put it in context of the broader moves we've seen for most of this year. We're going to take a look at other asset classes like we always do, especially in long-term bonds, which are making an interesting move this week as well. And then finally, we're going to take a look at our trade idea of a stock that's got its own little bullish pattern, a little bit more bullish than what we've seen, a little bit more of a bullish bounce than what we've seen from the broader market. So we'll talk about how to trade that one. So let's go ahead and get started. Today is Friday, June the 24th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit that red subscribe button that pops out. You can also subscribe down below the video if you're watching us on YouTube. Hit that thumbs up icon to like us. Comment down below. Join our website at MarketScholars.com. There's a link popping out up there in the top right corner of your screen. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, come down here on the bottom, click on that heart. It takes you to our new tab here. Hit that like button. Also click on this thumbs up icon. It takes you to another new tab. Hit that like button as well. Again, the more you do that, it helps get our content out to more of our followers. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. And you can see we have eclipsed that minus 2.5% mark. So we're now only a percent below the 30-day moving average. We got up through the 23% retracement of this current intermediate decline, which really, I mean, we peaked on March 29th, started this decline on March 30th. We are now almost at June 30th. So this has been almost a 3-month intermediate run to the downside. I mean, yeah, a little dip there, but it couldn't quite, it got above 50, but it didn't get into bullish territory. So technically, this is all one big run, one last hurrah here. That's a pretty long intermediate run. They generally last 1 to 3 months on the upside. So kind of cut that in half on the downside for your average. And we're pretty long in the tooth. Right, this one over here, you can see we peaked in the beginning of January, and then we ended here in March. So we went a little bit more than 2 months by the time we bottomed out in the beginning of March and rallied. So, and had this brief, very short-lived intermediate run. But that was, I mean, that broke up these two. So the green line is based on the current intermediate decline. The orange line is based off the 2 intermediate declines, so the market sentiment decline. The orange line now is at 20.6, so that much closer to dropping below 20. So we rallied up past the 23% of the green of this intermediate run, and we're sitting right at the 23% line of the current market sentiment. Remember, pullback start, so this pullback would be to the upside here because we're on a downtrend. Pullback start when you've broken above those lines, and then your first resistance layer would be right there at these 38% retracements. So you're looking at about 40, 25, up to about, basically up to about 40, 90 in this range would be your resistance level. Now you also notice a significant break here of 2 other lines. So today's move got us through the black and the red line. Those are based off of rallies. The red line is based off the rally. This is a 23% retracement of the big post-2009 low point rally, so long-term rally off that the last real bear market that we've had. And then the black one's based off of the COVID low point, the last correction that we've had, there. So we had broken both of those the prior week, and then on to, earlier this week, we've been kind of staying below it, but then this week breaking above that. So, you know, there's a good chance if we can stay above those two lines, and this might end up being kind of a fake out to the downside. But if we don't hold this breakout and these two resistance levels hold, these 23 lines hold, then, and we get back down below 37.85 and work our way lower, then we're looking at the potential of a fake out to the upside, right? That today was the fake out. When you look at the potential for like a runaway gap, which starts the intermediate runs to the upside. So let me go back here really quickly. So here's this move right here, and you can see a little bit of an intermediate rally that started on 315. So if I were to go to the 4-week range, and let's go back out to like, I don't know, let's just go back out to the beginning of March to kind of get a sense of what it looked like then. So here's that 315 move, a little bit of a gap to the upside. We filled it in. We never really did get a runaway gap. If anything, that would, but we filled that one in too. So we didn't really get like a true runaway gap at the beginning of a move. Over here, this has a little bit of a potential from 621 of being a runaway gap. We gapped up to the upside. We filled in some of it, but here we go gapping up, and we really took off from the open. So if anything, this has the potential for being a runaway gap. You can see here, if I go to the daily price moves, down here at the bottom, you can see it was over a standard deviation, and then we finished above 3%. The first time we finished. Now, the last time we finished, finishing above 3%, we finished above 3% after the first 3% drop that we've had. We have since had 5 3% drops, 2 of them here more recently, that have led to these 2 bullish moves. But the last time we had on May the 4th is the last time we had a 3% move to the upside. So if I come back over here to May the 4th, so that was right here. No, May the 4th would be right here. There's our last 3% move to the upside. We immediately came back down, right? So we were kind of coming off, had a pretty good move. Looked like we were kind of, had a fake out to the downside below these lows. We came back up, okay, and then not so much the next day. So that was 5-4 would have been like middle of the week. 5-4 because it would have been a Wednesday. 5-4 would have been a Wednesday, and then we immediately came back down on 5-5. A little bit of a difference. The near term line's higher. It's not the first time we've been above 90 on this run. We've been above 90 multiple times. Over here we were above 90. Right here we were above 90. So getting above 90 is actually a good sign of a reversal. We typically don't get a reversal when we're this bearish without one, but not all of them turn into rallies. So a good sign. The momentum line did not get up to high levels. The intermediate line is above its market sentiment line, though it's not out of bearish territory yet. So we're not bearish anymore. So needless to say, we're not bearish anymore, and we have the makings of a pullback starting. Now the question is whether the pullback will turn into anything more than that, right? Because if it pulls back into resistance and holds, as it's done, then we just move back down. It's got to get above that 78. It's really got to get at least probably above this area here, 44.25. 4,400 to 44.25. We get through that area, then we have a good chance of it. I mean, look, that's how far you'd be above the 30-day moving average if and when that happened. For this pullback to really be the beginnings of an actual potential move to new highs, right? Right, to new highs there. As you expect all correction bounces to get to new highs, and if they don't, then there's the chance that there's the chance. Like for an example, the last correction that did not get to new highs was early 2008, and kind of give you a sense of what kind of bounce that was. So it'd be right in. There's 2007. So here's 2008 right here. So we had this rally from October. Let's just go here. So here's our rally from the high on October the 12th. We got our highest high point. So if I were to draw my Fibonacci lines from when the correction started to when it ended over here in March 17th. So that correction lasted, multiple months. It lasted 5 months. We're 6 months in the current one. So that one lasted 5 months. We rallied up to the 50% retracement by the time we failed, the correction bounce failed. We got through the 38. We got above the 23. We got through the 30. We got up to the 38 and stopped. We got through the 38 and it looked like things were looking pretty good. But then that was it. Like we got back down. We got back below the 38. We eventually got back down below the 23, and we were off to new lows, right? And eventually off to really new lows, right? So eventually all the way down. So that's how bear markets start. So 50%, if we were to get to the 50% level now, you're looking at, here, do I have it? Okay, yeah. So if we were to get back up to this, so it'd be this orange line, right? That'd be the current correction drop that we're on. So we'd have to get above this, essentially, like I said, to get above this 4250 level for us to feel really good about, the potential, really more like the 4400 level. We'd have to before we feel really good about it, not having a failed correction bounce, right? That will actually get through to new highs, which is every correction typically leads to new highs until it doesn't, right? And when it doesn't, that's what leads to bear markets. And so that's the layer we'd be watching for. Whether or not this is the rally that will take us there, again, that took time too. So I told you it took 5 months. It took 5 months to get there. It took 5 months for the correction. Well, the bounce lasted from mid-March to mid-May. So it took 2 months to bounce before getting back down in a matter of another month and a half, 6 weeks, to get back down to where that 200-day moving average was, 200-week moving average, which is the tipping point of when bear markets start. You get the correction, failed correction bounce, the drop back to the 200-week moving average, and then the tipping point. This is when bear markets start. And remember, in this case, the stock market lost, whatever it was, 35-40% from here to the low point. By the time it was all said and done, over the course of from June to the end to March, so 9 months. And this is one of the shortest bear markets that we looked at. I believe the 80-82, that was like a 6-month long bear market. But the other in the early 70s and then the early 2000s, the early 2000s was like 18 months that we were in bear market mode. So after we had the correction, after we had the failed correction bounce, after we dropped back to the 200-week moving average, from that point to the low was like about 18 months. That was a really long one. So you can see like any correction, like it's taken 6 months so far. Any correction bounce we get will probably take a couple of months. And we will probably still be stuck in this area here. If we're going to fail and hold resistance, we're probably, and to kind of give you an idea of where that 200-week moving average would, or the 30 and the 50-week moving averages would be by the time we got there. You can see like right now they're at, so if I were to draw the Fibonacci lines here on the current market sentiment decline, we'll set this color here and color here. So there's that 50% we talked about. That's how far we got on the failed bounce before. There's that 62% retracement. That's where the 30 is now, and the 50 is there. So by the time we got to them, they'll probably be down to the 50% level. And then it's a matter of whether we'll end up holding the move up above them. I don't think we're done. I don't think this is going to get us there first. I think we still have more moves, because if you notice here, in terms of how far below the 8-week moving average we are, if I were to come back over here and take a picture, we're really below. We're 8% below. If you look at all the way back to like 1980, that's a low level to be that far below the 8-week at very short term. We were there at the very end of 2018. We were there in 2011. There's the correction phase of that bear market. So this is the first correction phase. That's when the bear market started. There's your bear market right there. So this part of that was the correction phase, and you can see we got down there then. So here's the bear market. There's the correction phase of that bear market. We got down there too, right? And then we washed out on these bear markets. We washed out on COVID. There's 1998. We dropped down to this level, very similar to 2011. And so forth. So that's how we are pretty far down. Now, if you go back out to 2008, again, when so the last bear market we had when we hit that lowest level here, when we hit that lowest level on the on how far below the 8-day moving average, 8-week moving average, where it was only 7% there, we actually stayed below the 8-week moving average for another 10 weeks. And we actually went a little bit lower, even though we had a really good 2 weeks after we hit that low point. We had 2 really good weeks, but we stayed below the 8-week moving average for 10 weeks after we hit that low point. So we're just now hitting that low point. And even with a great week this week, we're still below the 8-week moving average. So there's a good chance we stay below the 8-week moving average for however long after we hit this low point, while we kind of converge, right? If you notice, we kind of converged, like we got above the moving average, but we still were negative until we finally started to trend higher there. So we can be above the moving average, but still be below zero and be negative as we stay below the 8-day until we turn around, until we get above the 8-week, and then start our correction bounce. So I think we're in that mode of maybe 6 to 8 weeks of staying down and reaching this 200-week moving average like we did in 2008. See, we didn't quite reach it on the closing basis there, and then we rallied, but then we ultimately did reach it on the closing basis, however many weeks later, 8 weeks later. I think that's what we have coming up right now, that type of move. You can take a look at the weekly chart on the that we look at here, and you can see it's a bearish candle, a little bit of an upper shadow this week. You still have we were still well below the 10-week moving average, still well below the 40, 5% below. It's very, very, discounting the COVID drop, because that's more of an anomaly. That's deeper than the 2018 correction. It's deeper than the 15-16 correction. It's deeper than the 2011 correction. And it's actually about as deep as the correction phase of the last bear market, right? And then you can see there was no corrections in that bull market, that in between the last 2 bears that we had. So we're pretty deep here, and we're getting a pretty, it's not a bullish candle. It's not even very much of a transition candle. A little bit of an upper shadow, but definitely not as bearish, because not only did we not close below that low, we didn't even get a lower close. So, and we're trading up here towards the high, which means we're going to end up with a small body starting us off next week on the weekly candle. And you can see from a market forecast standpoint what the weekly market forecast looks like. Remember, we got that cluster last week, which is so rare. And we had a good week, but not good enough to get the near-term line even out of bearish territory. And the momentum line barely got into the upper half. So you got to need more than just 1 week. Well, we've seen bullish weeks. We've seen, we had a bullish week right there, and that actually did get the momentum line up to a higher level than we got now. The near-term line was also higher than we're at now, and that didn't last very long. So I think we're kind of done with these kind of big moves to the downside, especially on the weekly chart. I don't think we're going to get another 5% move, here. I don't think we're going to get another 5% drop to the downside anymore on this current correction. It's going to be more 1 to 2%, so it's going to be smaller moves than what we've been accustomed to, because the VIX just isn't very high. I think we're still in that mode of working our way to finishing the low point. We got 2 green arrows. We got 3 green arrows in the Qs. So we got light green shading. Now the question is how long that light green shading is going to last, right? For us to be really bullish, the light green shading has got to last more than just a day. If you look at, here's the intermediate run. This is kind of a quasi, very shallow intermediate run. Now the question is whether this 3 green arrows will be like that 3 green arrows, where it was basically lasted 1 day, and we were right back down to a new phase to the downside. Just like you get when you get the 3 red arrows on a bullish trend, they last 1 day, you go right back up. So really important start to next week. If we can get green shading on Monday, and on the Qs, if we can keep the green shading going all week long without getting back below the moving average, then that's going to go a long way for us being bullish. If you take a look at some of these other oscillators, they're not really that bullish. Like, we got above -20, but we're not above 25 yet. And we've been above 20 multiple times without getting above 25. The negative indicator hasn't even dropped below 25 itself, much less drop below 20. So the Qs, a little bit more bullish. This positive did get above 25, but you see it got above 25 over here too, and this negative got below 20, and it's nowhere near it right now. So we're, this isn't the most bullish breakout, right? We're not in the upper half of this yet. We're barely above 0. we're hardly showing. In fact, this kind of shows more potential for declines off of this. See, we're right at the blue line. We're still in a bearish trend, even if it's weak. It's not quite intermediate trend strength, but it's still bearish nonetheless. We haven't dropped to zero there. I showed you the Arun indicator before. I talked about how that's got to drop. There's a cycle to this, right? This drops below 670, the green hits zero, and then you get your spike to 100. We didn't quite get the spike to 100 there, and we saw what happened. So we haven't even dropped below 70, much less, and this hasn't dropped below zero, much less spiking it to 100. And you can see also the other thing too is what we've kind of been keeping our eyes on is that McClellan oscillator. It went positive, but it's not above 100, right? And we got above 100 there, and that was the peak. So when we get above 100 and it doesn't turn us around, especially when there hasn't been a minus 100 move, then that ends up being the peak when we get that strong. So finally, I want to take a look at volatility. You can see we did finish below 95%, so pretty bearish. That's the lowest close in volatility that we've had on a daily basis for a while. We're below 27. Even VIX 3M finally closed back below. Remember, at VIX 3M, it's so rare for it to be above 30 when you are when your VIX isn't capitulated. So we're above 30. The other thing too is kind of crazy is the VVIX is back below 100. The VVIX is really low. The relative VIX to 3 is really low. You would think that we were looking at this chart without looking at the S&P. You would look at this chart and think, dang, we must be pretty bullish, right? These must be kind of shallow declines, kind of intermediate pullbacks, but we must be on a bullish trend. Obviously, that's not the case. So volatility is kind of showing us a mixed picture with, volume still, lower. Today's volume wasn't very high. We're still got a very high ATR here. The range today was below average, but that doesn't include the gap, which was 378 to 381. So you're looking at about another 3 points. 11-point move, well above the ATR. So big move. If we can follow through, great. If this ends up setting the peak, then we've seen this story play out before. Here's your Bollinger Bands. The Bollinger Bandwidth is really peaking at really, really high levels right now. Right? And again, take away COVID, but you can see there's other levels where we've peaked. You go back out to 2008, right? The correction phase of our last bear market. You go to 2008, we didn't quite even get this high here. But you notice when we did hit this peak and rolled over that we were really bearish there. The MACD, we were below the 8-week moving average at the lowest level. But you notice it took still a couple of 10 weeks, a couple of months to stay down. And the Bollinger Bandwidth came down. We never did get, we had a brief little move into the upper quartile of the bandwidth there. But it looked like we were going to just V-bottom there in January. We didn't. We just stayed down. And so same thing here. Like, we're not quite getting into the upper quartile of the bandwidth. And right now we're barely in even the upper half of the bandwidth. So, let's see if we end up getting the break to the upside that really signifies that this thing is done. Now, it'll probably take a little bit of time. It won't happen Monday or Tuesday. You can see the momentum has been bearish. It's barely turning up. The whole chart, the whole moving average that we look at here, when you look at it, it's turned bull. We don't have the parabolic SAR flipping yet, but you got a really good momentum here in terms of how close we are to the 200-day hole. We're well above the 20-day hole. In fact, we're probably stronger above the 20-day hole than we've been in a while. Let's see here. Let's take a look. So yeah, this is the highest level that we've been above the 20-day hole this whole time. In fact, we have to go back to COVID probably to see a higher level. You'd have to go back to COVID. And this is higher than any level we saw in 18 and 19. And when you look at the momentum, the MACD, in terms of how fast we've gotten to this peak, it's really strong, higher than any momentum peak. So again, it's got potential of being the type of move that gets you going, at least starts the failed correction bounce, but it also has the potential of being so fast in such a short amount of time in the course of 5 days that now we just peter out because we've lost, we've pulled forward all the buying into these last few days and today. We've essentially just, because this happens all the time, you hear me talk about it, You same whatever moves you get down here, you tend to get up here. But until you get consecutive moves like that together, until you can start stringing them together, let me show you the last, like to 2000. Let's go to 2018, the kind of normal correction. Right, when this ended in Christmas, right there, we got that big move to the upside. It was a 5% move to the upside, but then we strung together some positive wins. So over the course of however many weeks that was, we only had 1, 2, 3 down days. We had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 up days, right? That's what you need to really get a correction bounce started. And we haven't had that. We get an update and we drop. We get a good update, we drop. We get a good update, we drop right back down. We have some 2% declines, and that's my opinion. Is that's kind of what we expect that we'll see. And one of the main reasons is because the VIX is where it's at, and you can see, like I said, this intraday chart here. We filled in this gap. Whether we'll fill in that gap or not, if we fill in that gap, there's a good chance we can be bullish for a while. If we can't fill in that gap and we hold resistance at the midpoint of this 4-week range and start and trade back, and because again we're in an area of very little volume, we can go down as easy as we can go up. We can go up pretty easy. There's not very much volume above us, but we can also go right back down pretty easy because we went up so fast today. There's not very much volume below us, so we're kind of at a tenuous point here. And like I said, it's very bullish. That you wonder about whether it has enough staying power, enough juice, like we talked about in our last video, to really sustain a prolonged run. I don't think it does. What do you think? Do you agree with that technical assessment of all these charts we looked at? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that would suggest why you're either a lot more bullish or a lot more bearish than I am? All right, now let's take a look at what's driving the price action. You can see a big risk on day today. 3.5% for the Qs, 3% for IWM and SPY. Developed markets did really well. Emerging markets up 2 1/3. Commodities were up 1%. Gold, the dollar was down. Long-term bonds were down 1.5%, which is fascinating because usually a jump in yields has been associated with risk off here lately. When bonds fall, stocks have fallen with them. But for the 10-year yield to jump up, it didn't jump up a lot, but it jumped up, to a 1.86, but basically 5 basis points off that low point. And for stocks not to falter is actually kind of a good sign for the yield as it's been converging here. It's kind of a long-term convergence going on as, the MACD is below its moving average. You're still above the 17-week, but it's getting lower, right? We're converging. It appears that we might be trying to form a peak, kind of like here where we were converging. We stopped going up because the MACD wasn't above its moving average anymore, it's below us, and the histogram basically was negative, even though you're still above the 17-week exponential moving average there. So this brings up this tweet I brought up here. So here's the last 5 days. The Q's up 8.6%. The IWM, SPY up a lot. Real estate doing really well. Gold's down 1.5%. Commodities actually down 7%. So big move in the last 5 days. But I wanted to put this move in the context. So here is off the peak from June 8th peak. So to put that move in context, let me show you where that June 8th peak was here on SPX. It was right there. So that from that peak, so this decline that we had since then, this is what it looks like, right? We had that decline. They were down 12 to 13. This is where they're at now. As great of a move as we've had in the last 5 days, put it in context of a larger run, and that's where they are now. The S&P is down 6%. The EWM is down about 5%. The Qs are down 5%. IWM is down about 8% still. So despite this great rally, that's where they're at. You pull it back further, if you pull it back to this move from that peak on March 29th, so March 30th going forward, this is what this last 5 day run looks like. Like now the Qs are only down 20%, and IWM is only down 17%, and the SPY is only down 15%. Bonds are still down quite a bit, and you can see commodities are well off. They were up 17.5%, now they're only down up 6%. Pull it back further, so this goes all the way back to the beginning of the year. Commodities are up 32% off, well off their peaks. The Qs are down 26%, but at least they're not down 32 or whatever it was anymore. So this is the last 5 days in context of the broader move that we've had pretty much since. I don't know why it's not showing up there, but this is what it looks like here. So if I were to go back to the asset class comparison and go back to the beginning of the year here, all the way up to now, so let's go like 30 minutes so we can keep it all on the same chart. So there's the move and there's the run, right? So it goes all the way back to there. Here's the last 5 days. So now that last 5 days really doesn't look like much, and that's the way it is. I mean, look, we've had lots of up moves. We had that up move, we had that up move, we have another, like that's the way it is. Like until things can flip around and change, well, that's how we look at these. And you can see TLT has been its own little convergence pattern. You can see this is the weekly chart. Excuse me, let's get back to the weekly. Here's the weekly chart. The MACD is above its moving average, really, really low levels. And you're trying to get some kind of like hammer pattern last week, engulfing pattern this week, long lower shadow last week, longer upper shadow this week. Long upper shadows aren't nearly as bullish as long lower shadows are. But you can see it's trying, right? The MACD is above it, it's green, but we're not nearly even close to being above at 17. So kind of very similar to like right here, very similar time frame where we were just barely, the MACD was just barely positive, and we were just right around the 8-day moving average. And it took a few weeks before we finally got above the 17 week, and we started a bullish move. That's the kind of move I'm expecting out of TLT because, again, it's corrected. It had a failed correction bounce, and now it's in full-on bear market mode. And I believe it's getting to the point where we're eventually going to be washing out of this correction. See, we're almost done with the monthly candle. Here's that monthly candle. Look at that. I mean, that's just really, that's significant. I mean, you have to go. I mean, this is go all the way back, as far back as we can on TLT. This is as far back as it goes on the TOS platform. I mean, that's as low as that MACD has ever been in the biggest bearish market that this has had. This is a 200-month moving average now. To kind of give you a sense of how often SPX gets below its 200-month moving average, it did it in 2008, 2009. It did it in 73, 74, and that's about it. Like, it's hard to get below the 200-month moving average, and TLT is down below it, right? This is a pretty bearish move, but it also kind of limits the extent of that bear market. That's typically about as far as things go when you get that deep. Such a stark rally. Bitcoin's another thing we've been kind of watching on the other end of the risk appetite spectrum, because it's been sitting at a really important level, right around 20,000. 20,000 being a 20,000 being more of a kind of a big round number, right? Because 18,000 is really where its major support is, right? That's where that's where that 78% retracement level is. We are well below the 62, and again, there's not very much volume here. There's the 200-week moving average. We're below that. The MACD histogram appears to have bottomed. Again, that's kind of thrown off by, I don't know why they can't fix this bad print on their data service. Thinkorswim has been notoriously poor at fixing their data problems that they have, but you can see that it is easily below the 200-week moving average, and it's not participating in this little rally that we've had. One thing that is starting to pull back a little bit is commodities. Remember, when commodities will pull back at the end of a correction, right? Here, let's go to crude oil, and let's go back to that 2008 time frame, that initial correction. So initially, when you are starting that correction, you can see crude oil actually pulled back, actually rallied because the correction started in October. Crude oil stayed bullish going into it, but by the time that correction ended and we got that drop in January, then we finally had a little pullback. All it did was get to the 30-week, but then it rallied again on there. Well, here we are finally somewhat below. I mean, we tried to get below the 17-week. A little bit of a lower shadow. We are in convergence mode, but we're not really remember, the markets have been in correction mode the last 6 months, and this has been above the 17, above the 8-week for most of this time, and above the 17 week for all of it, and even with the convergence that we're forming. So crude oil still is kind of not had that drop that really kind of ends the correction, but is also a sign. Here's another one of those signs that this correction has a lot of things going that says that this will eventually lead to a bear market, right? That we'll get a correction, failed correction bounce, drop back to the 200 week, and then the breakthrough that leads you to the bear market. Again, what we've seen in that, this is the pattern, right? Drop to the 200 week, failed correction bounce, drop back to the 200 week, and then a break, right? That's the bear market, and we've seen that before in stocks, right? Here's the last bear market we had: drop to the 200 week, failed correction bounce, drop back to the 200 week, and then the break. So from there, that point right there is when the bear market actually starts, right where my cursor is. It's, you know, it's a correction there, and we expect all corrections to get up to new highs, just like all the rest of them since have done. But when they don't, when they fail at these moving averages, then that's when we're like, and especially when they drop back to the 200 week, that's when we're like, okay, I mean, that's when bear markets start. Look how much we declined after the bear market started for, again, like I said, 9 months. You go back to, if we go back to 1970, you can again see the same thing in other real bear markets, right? So in 2001, we had the correction. There's our failed correction bounce back up to the 30-week moving average, and then we got back to the 200-week there in June 2001. And like I said, this was about 18 months of a bear market and a significant decline. And then that was 2000. See, did not go to 1970. So 1970 right over here. So there's 73, 74, the correction, the failed correction bounce, the drop back to the 200 week, and then the break. So from that point there in November to the end of that year, we had a year-long bear market, and you can see how much of a drop from 100 all the way down to 61, about 30 some odd percent. So, you know, you do get big moves, right, after bear markets start, and that's kind of how I'm picturing, that's how I see we're going on here. I think we're still kind of working our way down into these levels. But crude oil will drop to finish this correction, and I think we'll finish it over the next 6 weeks or so. We'll end up finishing this correction. Then we'll bounce for a couple of months up potentially to that level we talked about earlier. Crude oil will bounce up with it to new highs like it did in 2008 most likely. And then that's when the bear market starts, everything falls, including commodities. Okay, let's take one quick look at the sector moves here this week. So let's go to the sector. Whoops. Let's take a look at the 12 grid first. Let's see, do I have the right 12 grid up here? Let me just make sure. Yeah, let's take a look at the 12 grid here first. And again, you still have some areas of the market that are really bearish. I mean, look at energy. Look how bearish energy has been. Look how bearish materials have been. Financials and industrials are still dark pink shading and red lines. They've had good rallies. The rest of these have had pretty decent rallies too with light green shading. Only really one of them, healthcare, has got the green line there. Discretionary also has a green line. So we need to get dark green shading and green lines to really signify a change in direction in these. You take a look at the comparison chart here, and let's just look at today alone. Or let's look at the last 5 days, right? So the length of this rally that we've been on. So 1, 2, 3. These are the last 5 days. So that same thing we showed you before, you can see, I mean, look at the run on utilities and staples and you know, these safe haven areas. Energy really struggling, down 8%, materials up 2%. But, you know, big bounce back up. But again, you go back out to some of these time frames that we talked about. You put this move in the context here, and you can see, okay, there's a reason why those three are the biggest bouncers, because they're still down 20% since that March 30th. And look at utilities, and look at the rally utilities have gotten, you know, and staples, they're holding up really well. And in fact, energy, which was such a big winner, has pretty much lost all of its gains. And if I go back to the beginning of the year, to that January 4th, you know, you still got some pretty decent gains on energy, but it's lost a good chunk of what it had going into this peak. And you can see staples, healthcare, and utilities still holding their value really well, whereas technology, discretionary, and communication services, which have been the biggest winners in the past 5 days, are still down 24 to 30%, pretty much year to date. All right, for our trade idea today, I want to take a look at Starbucks. So Starbucks has had a really good move here, very much like the market. It's actually above its moving average though. By remember the S&P was still about 1% below. Yes, the Starbucks is well over 2.5, excuse me, almost up to 5% up above its moving average. One of the higher levels that we've seen this year for it. We just had a good move there, and then earlier when we were bullish, when it peaked, we were pretty far up above the 200, the 30-day moving average. When you take a look at its weekly chart here, you can see that it's also been, its PPO is really low. Again, for some context on just how low that is, let me zoom out a little bit. So you can see, that's like we haven't been lower unless we were in a bear market. That's the only time we've ever been this low. So you could argue that Starbucks is in its own bear market, even if the broader market's not. That Starbucks, let's pull this up here. Starbucks is. It hasn't really had a correction bounce yet. It's just been full-on correction mode. You can maybe argue, but again, a correction bounce typically gets you to the 30 or 50 week moving averages. So you could argue that this is pretty much a pretty deep correction, kind of like the COVID move was. Again, well below the standards of the S&P 500 where it's at. You can see that we are above the MACD is above its moving average. We're just not above that 17-week day moving average yet. If you take a look at its hull, the hull moving average, we look at three things here, right? We look at a bullish Heikin-Ashi candle, we look at the parabolic SAR flipping to the downside, and we look at the hull turning green. In this case, it turns green up above the 200. See, all these other times we've turned green below the 200-day hull. This is the first time in a while that we've turned green up above the 200-day hull. So a little bit of a bullish opportunity here that we haven't seen for a long time. Shoot, not even the past year. It's been, if you have to go back to get the last time we've turned green on the hull up above. See, all these were all below. That was the last time there. A brief little one in July of 2021. A lot of these were also below. So you have to go back to the beginning of this bullish move there at coming off the COVID low that we were above the 200-day hull. The hull was green at that time. Here's the last time it turned green above the hull while the hull was still red, right? So early on in the cycle. So it's been a while since we've had, a good break up above green, up above the 200-day hull moving average that hasn't turned green yet. And that's still red. So there's some opportunity. When it's not the most bullish of patterns, you can see from these other oscillators, we are above 25 in the positive indicator, though we're not below 25 yet. If you take a look at like the RSI and the CCI, you can see we are above 50, we are above 0. So we're not strongly bullish, but we're not bearish yet either. We're in the Ichimoku clouds. The first time we've been in the cloud for a while. We're above the blue line. We have the beginnings of a bullish trend that we haven't seen for a while. It's stronger already than what we saw on that bullish move. And again, we've had two big bearish moves here. So there's some signs, there's some pretty decent signs that Starbucks has bottomed and may be relatively bullish for a while. We're in the upper quartile now of the Bollinger bandwidth, even if the bandwidth is still relatively high and is most likely going to continue to grind lower here. And we're not necessarily, if you look at the whole, the Bollinger Bands with the Keltner channels, the bands are outside the Keltner channels, but you still have negative momentum that's just starting to turn up, and we're still inside of both of them. So we haven't broken out yet. And typically when you're changing the trend, you like to break out of that trend to really get going, at least outside the Keltner channel, and we're not doing that quite yet. So it's bullish, not quite as bullish as it can be. So what we decided to do on this was say, okay, well, let's do a relatively high probability trade on it. Let's sell at what was at a 33 delta when we did it. We might have to do the 76, 74 now to be able to get into this trade, depending upon whether it fills in or not. But you need to get at least 47 cents for this to play out, to get a good enough credit to justify the risk on the trade. And again, full position size because we don't have to worry about the earnings. This is what it looks like. Here, let me put this into the Analyze tab. This is what the Analyze tab looks like, and you can see the break even now. I actually had it before on a different, on the 75, 73, but you can see the break even on Starbucks. You essentially would have to break back down. You know, you had this breakout here today, the gap up, break above these highs. You have to break back down below all that for you basically to get out of the trade. Because remember, the break even right now would only be down 255, and I'm willing to lose 343. I'm willing to lose as much as I'm trying to make on these short premium trades. So there's our trade idea for the week going into next week to give us some positive deltas in case the markets do stay relatively bullish for another week or two, but not strong positive deltas in case things do turn around back down to the downside. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to like us hit that thumbs up icon down there. Comment, subscribe to our YouTube channel, as well as our website at marketscholars.com. Like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.